Welcome to the Source of Commercial Real Estate, where we discuss all things non-residential commercial real estate, including finding and funding deals, market intel, finding a competitive advantage, and using real estate to live the life that you want. I'm your host, Jonathan Hayek, and today I'm talking with Dean Zang with Marcus and Millichap. Dean has successfully brokered the sale of over $4 billion in retail properties in 38 states across the country and leads the firm's regional retail team. He's established himself as one of the top retail agents in the firm, consistently ranking in the top 30 of the over 1,800 agents in the firm. Unique and challenging assignments include the disposition of a 17-property leasehold portfolio during the Great Recession, the sale of the infamous Watergate shops and parking in Washington, D.C., and multiple sale leaseback assignments for Wawa Corporation. Thank you so much for joining me here today. Dean, how are you?
I'm great. It's Friday in the middle of the summer. I can't complain, Jonathan. Nice to be with you.
Glad to hear it. Good to have you here, Dean. Why don't we start out with you telling us about your background, how you got started in real estate, and what your work looks like today?
Sure. So I came right into real estate out of college. While in college, I was in residential real estate. Worked at a small shop right across the street from my dorm. It was kind of funny. I could walk out my dorm about 250 yards across the street, and I would be in my little cubicle. And, selling residential real estate in college, highly recommend it for anybody that wants to get into real estate because it kind of, you got your feet wet real fast, and it definitely pays for a lot of bar tabs in college. My signature sale leaving college was the local beer store we always used to frequent. So leaving college, I'm interviewing with a bunch of real estate firms, and Jonathan, to your maybe surprise, they all offered me a salary. No, I'm kidding. There was one that offered me a salary. It was Marcus, and it was enough to say, well, that's going to be the easy offer to take, and that was 20 years ago this past July, and I signed on with Marcus and was mentored by a gentleman that had been in the industry for many years. And we were in Philadelphia, and we just started rolling. It was a time before, brokerage was really, really involved in the internet and everything today with technology. So getting going was a lot of fun. It was maps in the back of my car, like many people in real estate can relate to, and driving around and looking at sites.
So I find your history of getting started in real estate interesting in college, because a lot of people in real estate kind of sort of, I don't know, back their way into real estate. They do 5 other things first, but you're in college, and I mean, it makes tons of sense because you can do it in your free time. As a residential broker, you don't necessarily have set hours. So when you were in college, did you view that as a college job, as like a summer thing, or were you like, no, I want to make a career of this, and so I'm starting to get experience now?
I've always kind of been entrepreneurial. I had a pretty strong and profitable grass cutting business with like 30 or 40 accounts. And, that was great, but I mean, it was hard work and hard labor. And that transition to sitting at a desk was nice, even though I was not paid at all and until you sell something. But the residential world, I was really kind of thrown into it. Mentors throughout my life have been the lifeblood of pushing me in the right direction. And this was a family friend who put me in an internship in college at his office. And he said to me, "You're going to go get your real estate license." And I was like, well, that sounds fun. I mean, I guess I'll go do that. And I think that was my sophomore year. And it was just an eye-opening part of my brink into real estate, because I was like, just learning the basics. And then I realized, wait a second, I'm in Maryland now. I need to get a Maryland license. So I went and did that. And it was just a fun way to immerse yourself and be on the front lines. And with sales, it's always eat what you kill. one of the other funny sales that comes to mind I could think of is I was selling a student's parents a house. He was a freshman, and brand new spec house, literally on a 3-bedroom rancher. And we get to closing, and it's like just before I go to graduate, and there's no sidewalk in front of the house, Jonathan. And the parents are like, "We're not buying this house unless there's a sidewalk." I'm like, "Well, sidewalk's not part of the deal." They're like, "We're canceling the deal." I was like, "You'll have a sidewalk tomorrow." I was like, I needed that money to go to Europe for a month after college. So, but that mentality has served me pretty well. And we had to get stuff done still. So,
Yeah, absolutely. And so 20 years in commercial real estate. So tell me about what sort of work do you find yourself spending time on today?
our team's business practice involves a couple little different niches. Um, we are very active in the triple net lease space and working for developers and taking their product to institutions and exchange buyers. We do some sale leaseback work, and then we also have a really vibrant shopping center business. And the shopping center business has a couple different facets of where we're executing for institutional clients on some of their maybe less high quality product. We're also executing for developers on kind of the most common form of shopping center development today, which is 2 to 4, 5, 6 tenant strip centers with high credit national names like a Starbucks or an Aspen, Dental, a Chipotle. And, that is a very well viewed asset class right now that's being developed all around the country by many different developers. And it's really tenant driven because if those particular names tenants aren't out doing deals, there's no center. So those are the different lines. And, one thing that I love about brokerage is being diversified, because sometimes the net lease business, like now, experiences a slowdown where, buyers and sellers are just on different pages. Meanwhile, the shopping center business, if the deal is priced right, which is usually under a set of pretty quantifiable leveraged metrics, it's going to sell. And you're not going to have 3 bids, you're going to have 15. So that business, while down, as well as net lease volumes are down, it's probably one that will be back on its legs pretty quick here in the coming quarters.
Great. So I want to go into two of those 3 verticals. So you talked about that you really focus on the triple net lease, like single tenant net lease,
Yes.
multi-tenant strip centers, and then the sale leaseback. I want to go a little deeper into the net lease space, the single tenant net lease, and then the multi-tenant strip. So let's start with just the single tenant net lease space.
Sure.
We know what a big impact interest rates can have on commercial real estate. That's no secret to anyone. But talk about just sort of, you're the boots on the ground. From your perspective, what sorts of things are you seeing? What patterns are you seeing in the single tenant net lease space right now?
Couple patterns. So I would say let's talk about first the buying side of things and the buyer profiles per se.
Mm-hmm.
Historically speaking, we've had a lot of different buyer profiles to pick from in net lease, but that's been reduced recently. So what do I mean by what are those buyer profiles? You've got institutions like Realty Income, Agree Realty, Exchange Right, First National. They've been very active on buying single tenant net lease. Those institutions, you've got Agree, which is publicly traded, as well as Realty Income. Different cost to capital structure, different way of raising funds than Exchange Rate or First National. For the latter two here are groups that are DSTs, meaning Delaware Statutory Trusts. They raise money from high net worth investors and sell fractional interests of properties. I'm pleased to say that in the last couple weeks, it seems like the DST market, fundraising machines, I should say, have come back on. So we're starting to see them reemerge as an active participant in the market. The REITs have been active and continue to be active all through this this kind of transitional period with interest rates, but seemingly just moving their minimum required cap rate out for a triple net lease property almost on a quarterly basis. One REIT in particular, it comes to the end of the quarter and it's been like, let's increase it 25 basis points. And that's been the pattern for the last maybe 4 or 5 quarters. So those are the institutional side. Then we've got 2 other categories we're kind of playing with as well in the triple net lease space. I would say it's just high net worth family office money, private money that, they've got money in the mattress. If they see a deal, they like the location, the geography, it all jives with them. They'll just buy it to buy it. They'll buy it because they have money in the mattress and they maybe don't want to have that money in the stock market or some other alternative investment. What's happened more recently is that pool has disappeared. Alternative investments and meaning bonds in particular, money market funds. I mean, if they're paying 5 and 6%, why put your money in real estate in triple net lease assets when we're still selling these things at 4 and 5% cap rates? And there's risk. I mean, they're definitely not as liquid. There's more cost involved in a transaction. I'm sure your listeners follow my thought process. So they've kind of moved to the sidelines, although I did get a phone call from one yesterday that is starting to dip their toe back on, which is a great sign. And then we've got the exchange market. And, the stat that's floating around out there as we talk now in August of 2023 is transactional volume across all real estate categories is off some 70% over the first 2 quarters versus last year. So if you had, let's just say in a perfect world, 7 1031 buyers, now you're maybe down to 3 if we're off 70%. So it feels that way. Some of the more modern trends, though, that relate to exchange buyers, I would say in the last 2 to 3 weeks, we've noticed an uptick in the amount of inquiries from those buyers. Some of that may directly tie to the California wildfires. Many of those exchange buyers were given extensions under by the IRS for their ID deadlines. And while I can't remember the exact date that they were given, it's clear that they're starting to appear on my radar screen. Our inventory is typically high credit, long-term lease products. So when you think of a Chase Bank, a Wawa, a drugstore, a Home Depot, all with term, with credit, that's the type of stuff we're really focused on selling. And so that's why those exchange buyers often appear at our door.
So talk to me about sellers right now. So it's been said that the only people selling right now are either people in distress or properties in distress. Is that kind of what you're seeing, or are there people that are selling just because, for other reasons?
Really, really good question, because the Wall Street Journal is definitely having a heyday with commercial real estate right now and writing articles all about them and painting commercial real estate with a very broad brush. I'll be clear, there are pockets of distress out there. That's obvious, specifically, I think, in the office sector. It was announced this morning, Capital One sold a portfolio of loans, $1 billion portfolio of loans to Fortress, that were specifically office buildings. I think that is the handwriting's on the wall. Those values have probably pulled back 50%. And, conversions are the way that the lifeline that office owners are being given right now to multifamily and self-storage and other things like that. But, when you look at the other product types, retail being my focus, retail is holding up remarkably well. We're not talking about enclosed malls. The Journal, I think I wrote an op-ed, which I don't think it's been sent yet because it's going through corporate review, but I told the Journal they need to stop talking about enclosed malls. There's such a small fragment of retail that it's just irrelevant anymore. And the huge majority of retail, open air centers, grocery anchored centers, large format, unanchored strips, it's healthy. It's great. In fact, Occupancy is at all-time high. Rent growth nationally has been exceptional over the last 3 to 4 years. So retail's fine. Apartments, rents are still growing from what I'm reading. Uh, Self-storage, A-OK, checking a lot of boxes. I'm probably missing a couple categories here that I can't really speak to as well, but I think the distress is very pocketed. One thing, though, to kind of put a bow around retail, it seems in the single tenant net lease space, which our focus of our discussion here, there's probably been it's hard to quantify exactly, but a significant increase in the amount of inventory on market. However, the inventory that's on market, Jonathan, it's not great inventory. And when you have a buyer show up at your doorstep that says, I want to buy a high quality, high credit ground lease. Let's think of the Chick-fil-A's, the McDonald's, even the Big Four bank. And you go out and hunt the eastern half of the United States for that in the $2 to $4 million price range, you're not going to find much. So I think that the oversupply is maybe, how should I say, overplayed. It's a lot of great, not so great properties. And, one of my colleagues, Barry Wolf, cloned this term commodity deal. And I think it's a very, very good term for a single tenant net lease property that's just kind of run of the mill. It's nothing special. And those are very hard to move today.
So talk to me about the tension then, because I'm coming from it as a value add investor. And so I hear about these properties that you say are, it's tough to move, but then I look at the cap rates that they're being offered at, and I'm
Yes.
like, well, of course, it doesn't make sense at this cap rate. So, why is stuff still being brought to market at such a low cap rate? Sometimes, if you can get financing at 7 or 7.5%, stuff is coming to market at 6 or 6.5%. And an investor like me is saying like, this just doesn't make sense. So talk to me about the tension, like how the quality stuff isn't coming to market for sale. And the buyers, the quality buyers, the institutional buyers are also not super active right now. So can you talk to me about, what's going to give? Well, first, do I have that summarized correctly? And then second, what's going to give to get volume back up?
What's going to get, boy, those are, now we're getting to the harder questions as we get into this. So I think that you've got, a little bit of like, we need price discovery to play out. And I think we're getting price discovery finally. Mm-hmm. That's, I think, a key element. There's the transaction numbers that, are being bantered about. We obviously have gone into a correction. We went into a correction because we were really so far tilted on the yield scale in terms of historical yields for real estate. We were beyond low cap rates. We're seeing 3s and 4s, and this was nothing. This was not Santa Monica. So, what will give? My hypothesis on that is somewhat simple to lay out. I think we're starting to see the early signs that private investors are realizing this period of getting 5 to, call it 5%-ish in relatively risk-free investments has a finite lifetime, and it's going to disappear. And it's going to disappear in, you could speculate 6 months, 12 months, not sure. But meanwhile, net lease cap rates have probably come up 50 basis points or so, maybe more, of course more in some sectors and such. But if you can call the bottom, like we'd all like to, and buy, an investment grade credit with a 10 plus or a 15-year-ish lease for around 6%, I think on a long-term play, you're going to end up, especially if that lease has rent growth, you're going to end up ahead of the curve, because I think the vision is long-term interest rates will come down. Of course, as I say that, the 10-year Treasury hits a 25-year high or something like that. So don't know really what's going on there, but the my better thought is that we're going to see some of the private capital come off the sidelines. Hopefully that'll also increase the number of exchange buyers out there, and we'll get back to some form of a happy medium market. It's not going to be like 2021 and 22, which, by the way, were the best of my career in the industry. But I think we'll have we'll like I said, we'll have discovery, and frankly, all we need is just stability. If we knew interest rates were going to be 5.5% to 6% for the next year, we could do deals. And I mean, you could get to the finish line. You wouldn't have to worry about tying up a deal, and you go to close, and your bank says, "Oh, sorry, got to up that rate to up that rate 25 basis points." That stuff's happening right now, and it's cratering a lot of transactions.
And I don't mean to put you on the spot and force you to tell the future. I mean, the future is anybody's guess right now. If anyone had a crystal ball and we knew where interest rates were going to be in 6, 12, or 24 months, we'd be making different decisions. But the truth is, we can only really look in hindsight, and 2 years from now, we'll look back on this time and say, shoulda, woulda, coulda. But at this moment, there's a lot of uncertainty. And it seems like in the interest rate sector, we are hopefully plateauing to an extent. And I think, in my opinion, a lot of what's driving some of the stagnation in the commercial real estate market is the uncertainty, and buyers like myself not knowing where interest rates are going to be. If I, get a 3 or 5 year term right now, when I have to refinance in 3 or 5 years, what's my rate going to be? Well, I don't know. I would like to think it's going to be lower, but I really don't know if I can say that with a high degree of confidence right now. So talk to me about buyers. I'm a buyer. I'm in a 1031 exchange right now. I'm looking for deals, and I'm always looking for a discount. So talk to me about buyer sentiment. Are you getting buyers looking for distress? I assume I had one broker tell me recently, buyers are always looking for distress. And so is that your experience? And are they finding it? Are you finding lowball offers getting any traction, or are sellers staying pretty put? Staying put in their pricing? What's your experience there?
It's really all across the board, I think, and asset quality is kind of the defining factor. So that's what I've noticed. The story that I would tell you is kind of funny. I was somehow got onto someone's email list that they would email you and simply say, "Dear Dean, I am interested in your property at XYZ Broad Street in Richmond, Virginia. I want to write you an offer. However, the offer will be half of your asking price." and I was getting like these emails from various people with that same line every day. And this was like in the last couple of months. And finally I started replying to them like, "Take me off your list." I think that gives you an idea into it gives you some foresight into the view that there is a perception of distress. But I would more so frame it, at least within the net lease market, as when you have a commodity deal, you as a broker have a seller that's either going to take the property off the market, or they're gonna capitulate to what the current market conditions are. And what's unfortunate is with some of the clients we've worked with recently, you start out at a 6 cap and you work the deal and you bring them in a 6.25 and they say no thanks, and they say keep working. And you go 30 days, 45 days longer, you bring them in a 6.5 cap and they say no thanks. You go another 45 days, you bring them in 675 cap, they say no thanks, and then you get the same. Then they call you 30 days later and say, well, go get me that 6.25 cap. And you're like, no, it's now a 7 cap. So it's, I think turn that around, Jonathan. You're the exchange buyer. Look, you're in the driver's seat. You can definitely pick the best real estate you want. And I mean, as of yesterday, I had a big exchange roll into a broker. He's my new best friend. He had like 30 million bucks to spend. And I mean, I was like, I'm going to ship you wine and flowers and chocolates. So we tidy up one deal. I mean, his buyer negotiated 15 basis points off ask price. And I was like, this is amazing. My client was so happy. I'm thinking he called me and was like giving me good jobs, high fives, everything. So, I mean, I was excited. This has been a challenging year. I mean, so I get the phone call or the email last night from that same broker. My buddy has got his wine and flowers and chocolates at his house in hand. And he goes, sorry, but your deal's now in second place. It's not going to work out. And I wrote him back and was like, what do you mean? What do we got to do to get in first place? And he's like, well, you probably have to be a 5.5 cap. And I was laughing. I was thinking in the back of my mind, yeah, we would do a 5.5 cap any day of the week. It was only a 5.15 cap. So with a 5 cap ask. So that's So to wrap that story into a nutshell, what does that tell you if you're an exchange buyer? It tells me that you go out into the market and the bid and the ask are really far apart, and the ultimate take is hardly what is being advertised today. And I've told this to many people. Like, if you see a property as a buyer in the market, you need to call the broker up and say, hey, look, I mean, I kind of see the property's value differently, but I want you to keep my number. Because if this guy calls you one day in the next couple of months and says, I'm going to sell it and I just want to get it done with, don't call one of the REITs, call me. And that's really, if I wish I had more people do that. Although my buddies at the REITs they love me right now because I mean I'm selling them so many deals. But there's those opportunities where you have capitulation in today's market for those commodity deals. And meanwhile, the other more high quality assets, the broker's still going to have 3 to 4 offers within 2 weeks, and it might go over ask. I mean, I lost on one last week that it was a 4.5 cap and it went over ask. How? I don't know. It's a good piece of real estate. So that's my 2 cents for you.
So talk to me about those deals that are still getting multiple offers and may be going at ask or over ask. You had talked earlier about quality assets. And so I wanna know from you what sorts of characteristics of these properties stand out to a buyer
Sure.
that make it a super high quality asset that they're still willing to pay these really high prices for them.
Well, look, it's still all about location. But the metrics of getting into a location are getting much more, as I say, we're learning to quantify them a little bit more. And in fact, some institutional groups I work with, have scoring mechanisms put together now to underwrite assets in their particular locations, and they give them a score. And if it doesn't have a certain score, it doesn't get an offer. With us, we're looking at the Placer data. And if any investor listening doesn't know what Placer.ai is, ask a broker, ask your favorite net lease broker. Hopefully they'll know and tell you. It is cell phone data tracking, and sometimes it's accurate and sometimes it's not. So nothing beats going and sitting in the parking lot still and counting cars, going into the store and secret shopping it, talking to the store manager. We do this stuff all the time. And just getting a handle as to what's really going on in the micro location and the performance of that particular tenant at that location. The typical things, traffic counts, 50,000 plus or minus. Excellent. Great. Demos, 3 miles, 70,000 plus. Love to see it. Average household income. That's one that's really become all over the place. And, I would say that when I came into the business, I felt like it was like 80,000. And now, I'm not sure where to go with it, because with the cost of living in different cities, from New York and LA and DC to others, in the DC metro, by way of example, an average household income, in an area that would be viewed more as middle income might be 150,000. But if you take that to the Midwest, that's probably an upper income area for housing. So we stare at that a lot. I continue to have an investment philosophy around corners, and it's been just preached to me by lots of different folks I've been mentored by over the years. And corners are always going to be leasable. They'll be desirable to more tenants. It's then all about access and understanding access. The size of the parcel, of course. I mean, 3/4 of an acre is kind of the cutoff point. I think more seasoned investors will focus on. Uh, you know, Basically for the versatility of the parcel into the future. The ability to do a drive-through, not do a drive-through. That's a big deal to a lot of tenants today. So, I mean, but I'll come back around to this placer, the placer data. It's we've had mixed results with it, and there are other companies doing it and looking at the cell phone results that are promoted. But the short story I would tell is I had a Publix deal I was selling for a REIT in Richmond, Virginia, and the placer data said it was the last or next to last store in the Richmond market for Publix. The secret shopper guy that we hire went to the site and said, this is the number 2 store in Richmond for Publix. So who won the argument? Who was right? Well, I'd say the answer is in who the buyer was. The buyer was a private family that was based out of Buffalo that is now in Florida that may be the largest owner of Publix in the country. So I think that answers who was actually right there on the stats.
So talking about placer data, I know access to that software is very expensive. Would like a family office or an investor looking for this data, does a typical broker have a subscription to Placer, or does Marcus and Millichap or your office as a whole have a subscription? If somebody wants access, can they call their broker and say, "Hey, I'm looking at this Wendy's. Can you give me the Placer data on this Wendy's?"
Sure. Marcus has a subscription of which we then, as individual agents, participate in. And,
Okay.
Yes, you can call your agent, and there's a good chance that if the agent is doing a good amount of business, they'll have access to the Placer. But I got to tell you, though, it's really, you got to have an agent or somebody that's an analyst that is able to explain the Placer data, because we can spit you out Placer data that will give you about half of the picture. And what I mean by that very simply is the store just opened. It's only been open 3 months. Well, that means you're going to have 1/3 of the traffic count of the normal store. So that's not really good data. Your store is 100. No, I'm sorry. You have a 20,000 square foot CVS store. I saw this one, 20,000 CVS square foot store. Well, wait a second. Everybody else is spitting out sales for a 12,000 one or 11.5. It's going to skew the data. So, the devil's in the details on that. The other lesson, a very contemporary topic to ICSC and my volunteer efforts with ICSC, shrinkage. I had a CVS deal in Philadelphia where the store looked great on Placer. Strong ranking, forget what it was, but it doesn't really matter. At the end of the day, I reached out to the guy at CVS and, hey, we're going to sell this deal. Want to see if we can tee up an early extension for the buyer. And he's like, yeah, I know your Placer data is good, but we're not going to be there long. And I think that is where Placer is somewhat, we need to get back to location. Shrinkage in that store was huge. And he said it was huge, and that's why they don't want to stay. So don't always hang your hat on the Placer.
And by shrinkage, you're talking about theft, right?
Correct.
Yeah, it's a huge, especially in urban areas. I'm hearing there are a lot of retail shutting down in Chicago and San Francisco and big cities. You just mentioned Philadelphia, because this is a real issue. Going along beyond Placer, you told the story before about the Publix and hiring the secret shopper. You'd mentioned before about sitting in a parking lot, counting cars, talking to store managers. I'm a DIYer to a fault, and so when I hear stuff like this, I'm like, "Ooh, this is stuff that I could really do," and I can walk into a store and talk to a store manager. Do you? I don't know if you've actually done this before, but I've heard of other people giving the suggestion of talking to store managers, asking about sales and how things are going, and employee retention, things like that. What sorts of questions? First of all, are you upfront and straightforward when you or someone goes into a store to ask these questions? And second, what sorts of questions do you ask to get the information that you want?
Oh boy, this wasn't on the prepared questions list, Jonathan, but this is a great topic. So my other role, which I may or may not be licensed for, is insurance sales. No, I'm joking. I sometimes would act as an insurance agent. However,
Sure, or
more
an
often,
appraiser or
you know,
something
an
like that.
appraiser,
Yeah.
but
Yep.
more often than not, I just go in and I'd say I'm thinking about opening a business, a non-competing business nearby, and I wanted to talk to you about how the store performs, because if your store performs well, then chances are my store will perform well. And they say, okay. And I'm like, I mean, look, so then I usually start with a inflating comment. And by the way, I have to give props to Tom Flacco, who's Greenberg Gibbons, who is the master of teaching some of this course in talking to store managers. But you start off an ego inflating comment to the store manager. Your store looks great. It looks like it's busy. I got to think this is probably the top store in the district. And they look at you and they, of course, say, well, yeah. And they'll say, we're definitely in the top. And then you say, well, like, so how many stores are in the district? Like 15? And they'll say usually back, oh, no, there's like 32 and we're number 3. So, I mean, I've literally had that spat back on me by managers. And then I usually get into, well, are the sales growing? Or are you just kind of floating along? And, have you renovated the store lately? What else? I do ask about shrinkage and just how that works. At the same time, I'm looking up at the ceiling tiles to see if there's roof leaks
Mm-hmm.
and things like that. And sometimes I'm really lucky that I'll have a client that will let the property manager walk with me, and we'll go store by store. And I've only done that once or twice, where the client said, hey, go with my property manager store by store. She'll introduce you and you just do your thing. And it made my life real easy. And on select assignments, we've tried to integrate that practice into our like preparatory efforts before we go to market. Because if I go to market as your broker and the buyer says, well, how's the stores doing? And I can rattle off like Sherwin is 33 out of 60, or some compelling statistics, and go right down the row on renovations and things like that. It just paints an amazing picture of the asset. We had one deal in Baltimore last year that we executed for Continental Realty, and they gave us free reign to do that. And it was like, we crushed it on that sale. Got a great number for them, and I could absolutely see why the client paid what they did for that property, because you just had a really healthy tenant lineup. So I really think that, I mean, the single tenant net lease investors, absent sales reporting by the unit, which opens up all sorts of information. So many of them just do not get in the car to go see the site. And I think I've seen a lot of mistakes made for that over the years by investors, because, they just may not catch something. I mean, Street View, yes, we've all gotten really lazy over the last decade. I mean, I remember I started this business, I was flying all over the place looking at sites. But now it's like we Street View it. if I'm putting my money down, I want to go see it.
Yeah, great advice. And thank you for going into detail because I really try to, nail down on some tactical tips that investors and brokers can get out of these conversations. And so I love those questions and how you would approach a store manager. Um, I've got just we're starting to wrap up here, so I've just got a couple more questions. Talk about opportunity for the value add investor, the family office looking for a discount or just a slight edge right now. How would you advise someone looking for value right now in terms of asset class, location, market, anything? Where do you see value?
I think the easiest place to tap value today is maybe, this sounds silly, but is still with brokerage inefficiency. Um, Brokerage I mean, there's so many different types of brokers, some of which are generalists, and especially in the smaller markets. I spend a lot of time over the Eastern Shore in the Delmarva Peninsula of Maryland, and I was at an ICSC event down there, and I realized, wow, like if I actually had to spend my life down here as a broker, I'd be playing across a lot of different types of real estate because there's only maybe 20 shopping centers. That's not going to feed you. So back to brokerage inefficiency, I think that finding some of those generalist brokers or brokers that are not at a big shop, that is an ability to uncover a deal that's not going to get mass exposed. Um, I also think that today, though I referenced that the internet and technology has really made brokers that know how to use it very powerful. I mean, let's face it, we got LinkedIn, we've got Instagram, we've got Twitter now, X, I guess that's what it is. We've all got websites. There's a million ways to promote a deal. But if you catch a broker that, and I hate to use this analogy, but it's very true, they're still posting their deal on LoopNet. Um, I mean, I don't know a lot of people that go to LoopNet anymore. Now, that was the standard in my mind for many, many years, for probably 10, 15 years of my career. And it's just now relatively obsolete. So, I think that's the inefficiencies I look for in single tenant net lease. Adding value in single tenant net lease is, I think, very challenging. I mean, you've got to have the tenant relationship, you've got to have the right line. But I think there's a lot of people that have those relationships now. So, I do believe that there is value to be added in scale today. So, what I mean by that is, we're in a relatively illiquid environment where the average deal size has tumbled this year. I mean, I wouldn't surprise me if it's down, 25, 35% this year. And so, an investor that has the ability to go buy a deal, maybe let's just say it's 10 million and up today. That's not an easy feat to get financed. There's going to be fewer buyers at the table. When you go way up the deal scale, you've got like Realty Income out there that's trying to aggregate portfolios and buy, deals that are, 500 to a billion plus. Yes, but there's a lot of stuff that happens north of 10 million and under that radar screen that I think is really interesting. And if we bring this back to single tenant net lease, the pad spin or breaking pad sites out of a shopping center is becoming increasingly popular by investors as a way to arbitrage a shopping center purchase. And we've even run into now a consultant that helps owners facilitate those pad spins. And she's immensely talented and knows kind of how to run the various verticals that are involved in that: municipal, civil, tenant, and that's a great service because I mean there's a lot of value that can be untapped if you have pad sites still in a shopping center attached. So that's been an exciting part of my job in the last year. I mean we get asked to underwrite kind of the business plan and lay out the business plan of pulling pads off a shopping center, and where you've got a Long John Silver's, which I mean, not the, I hate to say it's a less in favored brand, but it may be today. And, that's a pad that you would not want to go resell through us immediately. That's a pad you want to keep to get the tenant out of there and then re-tenant and sell them. So it's kind of, we have some fun doing that type of stuff.
Yeah. Oh, fantastic suggestions for adding value. Brokerage inefficiency, finding that deal that hasn't been exposed to the masses. If you can convert a deal that at scale, $10 million and over, there could be fewer players at that site, at that price point, and then looking for pad sites in strip centers. So, awesome suggestions there, Dean. This has been great. I've really enjoyed just catching up and hearing about kind of your world in the single tenant net lease space right now. If a listener hears you and wants to connect with you, where would you like to send them?
Just Google my name, Dean Zang, Zang, and Marcus and Millichap, or that'll take you to one website that'll have my contact info, and uh, hope we can help you. We love what we do. We've got a great team and a great staff, so it's a pleasure to serve any of the listeners that could use some guidance or transactional help.
Perfect. Dean, I sincerely appreciate your time and your generosity, sharing your time and your expertise with us today. Listeners, if you connected with this and you want to learn more, reach out to either one of us. We love talking about commercial real estate and we'd love to connect with you. Thank you so much for listening. I appreciate you. Until next time, take care.